As expected, the Fed held its target rate steady at 4.25% and 4.5% for the second consecutive meeting. In addition, the Fed released its Summary of Economic Projections for Q1, aka the dot plot, which indicated the average Fed member expects at least 2 more cuts coming by the end of 2025. However, this is the same as December, so no change there. What the Fed actually did do was officially announce that they were slowing down the pace of their balance sheet runoff, taking the amount of treasuries running off from $25 billion down to $5 billion, but leaving the amount of agency MBS capped at $35 billion. But again, this is something they telegraphed and didn't really catch the market too off guard. The official statement stated that uncertainty has been increasing, but during the course of his press conference, Powell stated that he thought the overall economy was healthy and in a good position, therefore there was no need to cut rates. The vote was unanimous, although there was one dissent about slowing the pace of the runoff, but nevertheless, they went ahead with it anyway. During the press conference, there was a significant amount of questions surrounding tariffs, which shouldn't be totally unexpected, and Powell admitted they're trying to get their hands around it. They're modeling a wide range of outcomes, including one that includes 100% retaliatory tariffs, although they're using that as a baseline for the worst possible outcome. Nevertheless, what they're trying to do is unpack what the effects of tariffs may be, the inflationary effects of tariffs may be, and split that out from other drivers of inflation. But Powell said this is going to be quite difficult. What was really surprising, though, is Powell indicated that they could potentially look through tariffs, that these may be short-term in nature. The word transitory actually came up during the meeting, believe it or not. But again, Powell said it's very highly uncertain at this time, and they're just really getting started. He did indicate, though, once again, that the economy was in a good place, and they were in no hurry to cut rates. He was specifically asked that question about the May meeting, and he said, "We are in no hurry at this time," which basically takes any sort of move off the table for the May meeting, barring some drastic change in the economy. I think for financial professionals, the same holds true today as it did at the end of the January meeting. We should expect a period of heightened volatility for the foreseeable future. To give you an example, from the end of the January meeting until yesterday, the S&P was down 6.25%. And from day to day, we have seen swings of 1% either way on several occasions. But at the same time, the Ag Index was up just under 2%. So it's kind of giving you a proof point that bonds can do for you what they're supposed to do, an offset to equity risk. They haven't been able to do that when rates were historically low, but now with the Ag Index between a 4.5% and 5% yield, they give you a little more cushion to offset against the equity risk. Now, I'm not going to say that the volatility won't touch the rate markets. It certainly will. But again, you have a little bit more cushion with rates higher to offset any increase in rates. And we think this is a good time now, potentially for financial advisors to re-examine their bond allocation.